Hello, everybody, and welcome to another Southern California housing market update for March 22nd, 2022. My name is Stephen Meade. I am your host here. I'm the primary broker here at Domicile real estate for people who love houses. And well, kind of an interesting week. If you're watching, the Fed has announced and said we need to put the brakes on the economy before inflation completely spins out of control. Obviously, those kind of statements have an effect on mortgage rates down the line. Ironically, those tend to affect kind of that midterm of mortgage rates. Believe it or not, banks actually want inflation to be low in the long run. So I think some banks have actually been pretty nervous about how little the Fed has been controlling inflation and where that's going. So kind of some mixed news there. But something that I've been thinking a lot about personally is this idea of the convenience mindset between Uber Eats, DoorDash, a lot of these services, and how are we seeing that start to show up in the real estate market? And the reality is we've actually seen that for a while now. And is that really having an effect on our housing market? And how is that changing things this time, different to kind of housing market conditions maybe 5 years ago, where we didn't have as much of that convenience mindset? I'll just tell you real quick a little story, and that is one of the things we're seeing out in the market is the rise of something called wholesaling. And a colleague of mine called me and said it's particularly infuriating to see this happen. And what had happened was he had a home on the market, right? He's a realtor like me. He listed a home, and they had received a pretty decent cash offer that might not necessarily have been the highest offer, but it was the most convenient offer, right? Easy terms, sellers don't have to do really anything. They can stay as long as they want in the property, et cetera, et cetera. And what he discovered, much to his dismay, was that this person who got their offer accepted on the house, this investor, immediately started marketing the property on their own for more money. So basically, they were attempting to act as a wholesaler, right, and take a cut without ever actually buying the property themselves. And, the question is, number one, is this right or wrong, right? That's kind of more of an ethical question. Is it in violation of the contracts? No, it is not. Our standard contracts in California allow something called assignment, which basically says that a person who, secures an offer, as long as the terms don't change, they can in fact assign that contract to someone else. So as long as it still closes on time, they can actually still assign that contract and sell it at a profit, essentially, to somebody else. So how are these decisions about convenience affecting our market? And kind of been thinking a little bit about that a lot lately. Let's jump into the stats, and I'll kind of tell you where some of this is coming from when we look at this data. So let's look at our total active listings, right? And that has stalled out a little bit in the market. If we look kind of at this under $2 million mark, we saw things grow out, but they've kind of flatlined out for this total active listings. For our under 1 million, significantly less than last year. And I think the discussion was, well, maybe some of those under those homes would then show up as listings in our 1 to 2 million. But that has also kind of flatlined out the last couple of weeks, and it is still below where we were last year. So the reality is total listings in the market is down, at least in any kind of the more common price ranges. So that's kind of stalling out a little unexpectedly. New listings in the last 14 days, right? This is something we like to see. Are we seeing that spring big growth? We are seeing a little bit more in the way of new listings than we saw last year in this 1 to 2 million, and a lot less in the way of new under 1 million. So overall, I'd still say we're at a net negative. We do not have as many new listings total in the last 14 days as maybe we would have had last year. So definitely a little bit of a bummer on that front. I think if you're a buyer, you were kind of saying, well, let's let those floodgates open. Let's let those sellers who are worried about rising rates put those properties on the market. But that hasn't happening. And I think the biggest reason why, and I'm going to explain this because I think this is something important to go over. Whenever I hear a consumer in the marketplace talk about something and an experience that they've had, I listen, right? Because I can sit over here with conjectures about what's happening. But when I hear an actual consumer, somebody who's not playing inside baseball, right? This is not someone in the real estate field, and they describe to me something that's happening in detail, my immediate thought is that it's actually a lot more widespread than one person. And what this consumer mentioned was, they said, I think the problem is just people don't want to put their house on the market because they don't know where they're going to go. And this has been a perennial problem for us, and it is a problem that is made significantly more acute by rising interest rates, right? Because if you are a person who bought a house for $500,000 a number of years ago, it is now worth $1 million, and you are looking to upgrade to a $1.5 million house, this significantly affects your costs when that goes up. So, you've already had the challenge of, am I going to even be able to find that $1.5 million house, right? And now the challenge that you're facing is, okay, even if I find it, I don't know if I can afford it anymore. Because I have to give up my super low mortgage rate that I refinanced to last year in order to buy that house, that $1.5 million house. It's not just 50% more expensive, it's 100% more expensive to buy that home. And that is going to affect that supply of inventory and those homes coming on the market. And, remember, the homes that came on the market in the last 2 weeks are the closed sales 4 weeks from now, right? And so when I see a chart like this is what tells me I don't think things are going to get much better in the next few weeks. And it concerns me because it goes back to this long-term problem. And this is really what I think is doing a great job at propping up prices, or even encouraging price increases in a rising interest rate world, which sounds counterintuitive, but this is the fuel behind that market. Really is a lack of supply. I know I sound like a broken record, but people want to ease that housing difficulties. Supply would go a long way to make things better. Now, here's our new escrows, right? And the good news is we are seeing a little bit better than last year here on our 1 to 2 million. Great. We're still well under market on our under 1 million. You'll see this one dip down a little bit. I think it's too early to say whether that's really a trend because of those rising interest rates, that's just reducing the number of people who are in that category are able to afford it. But the fact is, while we saw new listings kind of took a little bit of a dive in both, we're not seeing any relief. That supply demand balance isn't changing. And speaking of that supply demand balance, we have the numbers really to prove that. If you look at our absorption rate, here we are stuck in the high 80s, close to 90% for under 1 million. That means for every 10 houses that came on the market, come on the market, 9 homes will go into escrow, right? That is a very, very competitive market. Even in our upper price range, that is now in the 80s. I mean, this really speaks to a market that is not slowing down like people might expect. We're not seeing there be that abundance of supply that usually precedes price easing. Now, if you look at our closed prices, again, there's some variability in this, but I think if you look at this from the beginning of the year trend line, right, it swings up for all of these. Our 75th percentile jumped. This tells me those people in that $1.5 million range are saying we need to do this now or never, right? And I think they are concerned that rising interest rates will make it impossible, right? It won't get any easier to make that move up market. And while it might seem like I'm focusing a lot on this notion of that move up market, the reason why is that move up market is what creates the entry level homes for our first time home buyers. So if there's no people moving up, there's no entry level homes. You really have to rely on attrition, people passing away, going into assisted living, and essentially aging out of their houses. And really that is, I wouldn't rely on that for our influx of housing stock for entry level home buyers. Now, if we look at our percent still active, both of these are very strong numbers. We are trending below what our average was for 1 to 2 million. It is a little bit better maybe than it was last year for us, this measures of the homes that just came on, what percentage are still around. Lower is more competitive, higher is less competitive, but compared to where we've been in the last 6 months, these are competitive numbers, right? This is not an easy time to be a buyer. And as we've always said, I think it's a great time to buy a house. I just don't think it's a very easy time to buy a house. And then we have something that I am personally a little bit puzzled by, right, is the stickiness of this close to list ratio, right? I mean, things got completely out of control here for a minute in our upper price range, in our 1 to 2 million. I mean, where our on average, homes in that price range were closing for a 8% over list price. I really thought we were going to see a little bit of this with rates. We were going to see this ease back down to that 100 to 102% range. It doesn't look like it's happening. And this kind of brings me back, right? We have all this data that says our market should be softening a little bit, right? Days on market for new contracts. Yeah, did it go up slightly for 1 to 2 million? Maybe, but we are still under 20 days. I don't care. However you're measuring this, this is an ultra tight market by the days on market definition. This might have just been a temporary nice little blip, maybe. We'll have to see if that changes. But I mean, the reality is this is extraordinarily quick. And look at how long it's remained at this point. And this is both price categories. Our affordability has, deteriorated as we went into this new year. You see affordability deteriorate. As this goes up, it means what is this payment related to 2018 payments? And right now, the same median priced home is around 100 or 35% more expensive in terms of payment than the middle of 2018. About 4 years ago, I'm very tempted to add an inflation line over this because I'm very, very curious to see how those two do line up. My guess is we will see an inflation line that goes up and it is a little bit shallower than the line you see here. So maybe I'll have that for you guys next week. And then finally, let's just take a look at our prevailing mortgage interest rates. As you can see here, we've steadily been up. Ukraine situation, a little bit of relief, and then just boom, right back up to going up. And given the Fed's comments, I expect to see this continue upward. So why are we not seeing an easing in the market like some of these macroeconomic effects would signify, right? Why are we not seeing things get better? And I do think there is a component of this sort of, convenience mindset. I think you have right now, especially, you have buyers who are willing to overpay to get the house that they want. If it is a done, magazine ready, could be in the pages of Sunset or Dwell, well-prepared home, you host the open house, there are a ton of people in there, and there are people who frankly are at their wits' end and they are tired of looking. So they turn to their agent, they say, if we don't get this one, it's gonna set a new comp, right? It'll set a new floor for prices. If we don't get this one, we're just gonna pay more later anyway. So let's just pay more now, rip that Band-Aid off, get it done with. We are tired of looking. We don't want to spend any more time. We are frustrated. This is the house we want. It's done. We don't have to deal with contractors. Let's just give whatever we have to do to get it. And I think that mindset is driving prices higher. And I think that's a shift over where we were 5 years ago. I don't think consumers were so willing to trade their dollars for that convenience. The other thing that I always remind people of, and I think it's important, and we have a commenter, I know I need to write you a comment back, Jason. Mortgage rates are going up, right? But in a world where CPI is 8%, a mortgage rate of 4.5% is actually a negative interest rate. It means you are paying an interest rate that is less than inflation. I mean, your money is more valuable by taking out a loan, which sounds completely contrary, but it's true. And that is part of the other thing that I think is fueling this is nobody likes the payments going up, but at the same time, people don't mind borrowing money at a negative rate, right? If you're going to do it, that seems like a smarter way to do it. I think that is also what's continuing to drive our demand for housing despite rising prices and rising payments. Anyhow, Thank you guys so much for watching. We love you. Questions, comments. Don't forget to like, subscribe, and smash that notification bell so you hear when we have new videos that come up. We will be back with you on Friday for our first time home buyer market update. We also do an architectural video on Thursdays. Don't miss around for that. We do have a couple coming announcements that I'm super excited about, so I'm going to tease that. Watch those future videos because we're gonna make one of those announcements, I think, on our Friday on our first time home buyer market update. So definitely do not miss that. Thanks for watching. We will see you again real soon.